Podcasts. Hello, Smart Money Tree podcast listeners. My name is Kirk Chisholm. My name, Jesus, I can't talk today. Hopefully, our editor can figure that one out for our podcast. But today, I'm joined with my good friend Doug Hagren. Hey, Doug, how's it going?
Hey, Kirk, I'm doing better today. So if everybody is watching, they can see that I'm totally blurry and fuzzy, which is a continued issue with my, well, I don't know what's going on with the drivers, but that was my whole day yesterday. I actually had to cancel meetings yesterday because my left eye basically went blurrier than this, but yet fogged over like I was trying to look through Glad wrap. And I thought I had a detached retina, but it turned out there was a corneal inflammation. I don't know. All I can say is, I have a new appreciation for all those pirates that used to walk around with a patch over their eye because it was a long day.
I don't know, Doug. I'm looking at you, and I feel like it's a bad day to stop drinking. So,
Yeah, for those of you that haven't watched Airplane.
bum bump. All right. So so let's just get started. So Doug, a lot of stuff's going on. Let me just put this in context. I know we had a new CPI number out recently. It is down to 6.5%, which is probably a surprise to a lot of people. They probably think, hey, things are going back to normal. It's great. CPI is 6%, 6.5%. Tomorrow it's going to be 6, and it's going to go down to 2. We're going to be great, right? What are your thoughts, Doug? Are we on a glide path to a soft landing, or what's going on?
I mean, my first thoughts are I'm glad I'm not Great Britain because I think they just dropped down to 10.5%. I mean, you need to really. I mean, I think the perspective on this is the hard part because, I mean, it may feel good that we're down to 6, and obviously being down to 6 is an improvement over where we were. But I mean, if anybody out there understands the rule of 72, if you don't understand the rule of 72, basically, you can take 72 divided by any type of interest rate. It'll tell you how long it's going to take to double. Well, when we were going back over the last 20 years, we've had consumer price index averages in the last 20, 25 years have been under 3%. Many of the times it was 2.5%, even as low as 1.5% growth. So do the math on that. If it's 2%, if we just average that, it's going to take ultimately about 30 years for the cost of living to double. At this level, at 6.5 to 7%, you're talking about everything you pay for doubling in the next 10 years. And most people are not prepared for that. So it may feel good that we're down to 6.5%, but we got a long way to go. And unless there are some significant changes that everybody out there starts making to the way they think about money, because we have an entire generation, that has been, or two actually, maybe even three, because I've never even experienced. I mean, the last time we had massive inflation was in the 80s, and I mean, I was a baby. I wasn't dealing with that. So you go back to, late stage baby boomers, almost all of Generation Y, all of the millennials, and all of Gen Z have never experienced anything like this. And there's a lot of financial advice out there that is based on the period that they've lived, but not the period that we're facing. And ultimately, I know the Fed came out and they said that their target is still 3%. They would be happy with 3%. Many models use 3% as a long-term average for inflation. So if we can get back to that, that would be a wonderful thing. That means every 24 years or so, costs are going to double. But 10%, 10 years of doubling, it's going to get, it's pain. You think it's painful now, it's going to be really painful.
Yeah, I think what's interesting is the model, like you said, is 3%, and I want to kind of touch on this a little bit because so one of the problems that we come across in the financial service industry, there we go, bring a little light on me. One of the problems we come across in the financial service industry is that people make assumptions, right? Numbers are based on assumptions, and whether the model is correct or incorrect is based on those assumptions, right? So you think about something like highly complex, like global warming or climate change, or whatever you want to call it. Think of that concept. And we're not here talking about whether it's true or not, whether it's valid or not. None of that's relevant. But think about it from a complexity standpoint. The complexity of trying to model global warming or climate change is well beyond the comprehension of a human mind or computers at this point. AI is pretty nice, but even that's not at that stage. So think of the complexity of that. You've got lots of data floating around with different systems. Some of them are chaotic systems, some of them are non-chaotic systems. A chaotic system is randomized. There's no way to predict it, right? And then there's some systems which are very predictable. Climate has a little bit of both, right? There's stuff that's predictable and there's stuff that we don't understand. So maybe it's predictable, maybe it isn't, but we don't know understand it enough to know if it's predictable. So you think about the complexity of that, right? Now, let's say we're really good at modeling climate change. And then all of a sudden, one of the numbers is wrong, right? Let's say our models are correct. Like the models are great. We have the equations, the algorithms, we have everything perfect, but somehow one of the numbers is off. Well, now that throws off the whole model, right? It means the model is going to be incorrect because garbage in, garbage out, right? You have bad data coming in, you're going to have bad data going out. It's true with any model. So one of the challenges, not only the complexity of the model, and is the model correct and does it work, but this is the problem with any model. You get academics coming up all the time with models, and they try to explain things that have happened, but none of them are 100%. And these are really smart people creating them. So the lesson here is that a model is a good guide. It is not truth. It is just a guide of trying to find the truth or get as close to it. It's like science, right? Science comes up with theories, and eventually the theories are either proven correct or incorrect. But during that time, it's messy. People are figuring it out. Now, if you put together, if you come up with a scientific experiment, right, and you decide, let's say you're deciding whether, let's pick a political topic, whether ivermectin works on COVID, right? Let's really throw some sand in the gears here, and you come up with a bad study, right? Whether the study's bad, whether it's done improperly, or whether the data is bad, and you come out with the answer. People are going to say, "Oh, great, that's the answer." Well, maybe. I mean, it depends on the quality of the study, right? Maybe this quality of the study was bad. Maybe it was great. And people are like, well, but you didn't test this or you didn't test this. That's how science works, right? Is you're constantly testing the parameters, you're pushing the boundaries, you're having other people try to debunk what you're doing. That's a part of science. So modeling is much the same way. So if you look at using what you said, Doug, this 3% model for inflation, that's great. But is that a good number? Right? If it's a 3% model and you say, well, if I use 3% as a number and you save this amount a year, well, at retirement, you're going to have $1 million and you're going to meet your goals. But what if inflation's 5% over that period? Now all of a sudden your model's screwed up and it's wrong. And it's not your fault. It's nobody's fault. These are just assumptions that are not predictable. So personally, when I do models like that, and I'd love to get your opinion, Doug, because I know you do this a lot and you're really good at it. When I'm putting together these models and these plans, I'm putting together the most conservative numbers I can find. So if somebody's saying like, oh, well, a lot of advisors are out there and they'll say, all right, well, let's assume you're making 7% or 8% a year on your portfolio. Well, that's ridiculous. I mean, you have to put in a number, but if you're going to be that aggressive, then you're assuming that the market's just going to do really well for the next 20 years. I would never make that assumption. That is, you're really setting yourself up for failure. I use numbers whenever possible of 2.5%. I go really conservative. Now, of course, I'm not including inflation, so it's kind of all baked in. But my point is I use really conservative numbers because if you can overcome those conservative numbers, everything else is gravy, right? Just think if I put together a scenario that's really tough and say, all right, if you do this, you're going to be okay. And you're thinking, well, that's going to be tough. But yeah, but everything else should be better. It should never be worse than my scenario. So at least you know what's the worst thing that can happen. Okay, this is the worst thing. Now, what if we adjust up? What if we adjust this? And I think it's really helpful in doing it that way because if you just look at one number and say it's going to be X, you're just taking a shot at the dark. You have no idea if it's accurate or not. So while I agree, people use the 3%, I would actually use a much higher percent because I think historically, especially now, we're going to see 5% or more inflation for a while, which means that your numbers are going to be really screwed up from what you used even 1 or 2 years ago. So what are your thoughts on this, Doug? I know you have a lot of thoughts on it.
Yeah, well, I agree with you. I agree with being conservative, in within limitations, because obviously we have to find some sort of a balance between what we think can happen over the long run and preparing for that, and the ability to live life now and be able to not overcompensate for those variables that could occur, because we don't know. We have no idea what's going to, like you said, no idea what's going to occur. I mean, you could see, they have these stories about people that died almost penniless, and then they had, $3 million stuffed in the wall. I mean, so I think that there's a balance there. I think one of the things that I find is a great way of finding balance is, there's many people out there that think they do financial planning or think they have a financial planner, and they really don't. Okay. You got to stress test. You got to look at what the impact's going to be based off of what I call the certainty of uncertainty. So I'm a big fan of Monte Carlo. I know a lot of engineers use this to test their theories. Monte Carlo in itself is something that it's kind of like pulling the lever on a slot machine, and it's going to randomly come up with different things that could occur. And it's going to do this over and over. Now, the key concept in Monte Carlo with financial planning is it's effectively looking at, if we throw random inflation, random returns, all these things at your situation, do you at least have $1 remaining throughout your expected lifetime? And if you do, it's considered a pass. If you don't, if at any time you go negative, it's considered a failure. And it'll run this over and over. Generally, it's going to be 500 to 1,000 trials, or 500,000 potential lifetimes. We want to see a higher probability of success there. We don't want 100% though, because this is the way I look at it. Monte Carlo is not perfect either, but where it shows us is, it shows us where we're mostly right instead of totally wrong. Okay. Basically, if you pass, we don't know in that trial if you passed with only $1 remaining. If you only had $1 remaining at some point through your life, that's not a fun life. Okay. But at least you didn't run out of money. We also don't know if you failed by only $1 difference. Okay. So generally speaking, in the percentages that I'm not looking for 100%, because if I were designing a bridge and using Monte Carlo to bridge, I know I'm going to have high tide. I know I'm going to have low tide. I know I'm going to have rush hour. I know I'm going to have some hurricanes. I know I'm going to have all these stresses on that bridge. Okay. But I mean, there is a variable where a 747 could crash into it. Well, the bridge failed. Okay, so do we plan for that? Not necessarily, because if the bridge failed on a 747, how much concrete and how much steel do you need to put into a bridge to make it 747 proof? It's the same thing with financial planning. It's like there's only so much you can do before you're saving so much money that you have nothing left for today. And so I think there are definitely there are ways to stress test it, and you have to. And unfortunately, Kurt, too many people rely on canned advice from advisors, from websites, from, if you just do this, if you just buy index funds, you're going to be okay. I've done a financial plan, and it turns out it's just using, like you said, 8% return. I'll be fine. That's not planning. Okay. That is at best planning light, if not mostly it's speculation. Okay. And I could talk a little bit more about speculation versus compounding and different values there. People are always focused on the upside. They're not focused around what happens if you eliminate the downside. I ran a test that between 1997 to 2022, so 25 years, if you just stayed in the S&P 500 during that period, $100,000 would turn out to be, let's just say, around 500,000. Okay. And again, I did this a couple of days ago. I don't know exact. If you could eliminate the down years just along that ride, you would have about 1.3 million, $800,000 more by eliminating those risks. So this just ride it out and let it go, and I'm going to be fine on an 8% average return. It just doesn't happen. Okay. Because down years give it back. The other thing I want to talk about is again, like you said, what's inflation going to look like? Well, if we look from 1914 to 2022, the average inflation over that entire time period was 3.26%. So that's above the 3% rule for the full duration. Now, some people, they like the philosophy of, well, when did you graduate high school? What's it been since then? Well, okay, so I graduated in 1993. If I look at that till 2022, the inflation average over that tier period was 2.49. So again, that canned advice would assume 2.49%. But if I go back to 1980 to present, all of a sudden that 2.49% jumps to 3.32 again. So if we just use these short-term windows, it doesn't give us enough data. Last one I'm going to throw in here, because we all know we've talked about stagflation, we've talked about some of the tough periods of time. But if I go from 1970 to 1985, you want to take a guess what the inflation was for that 15-year period, Kirk?
70 to 85. I would say it's probably in the neighborhood of somewhere between 8 and 10%.
Well, fortunately, you're a little bit high, but it's not far off. The inflation average over those 15 years was 7%, 6.99%. So going back to what you said before, what happens? I mean, 15 years doesn't seem like a lot of time, but I don't know about you, but I look back 15 years ago, where did that time go? But if over the next 15 years, we are in something even remotely similar to the 1970s, and we cannot get that inflation back down, you are looking at everything you pay for as an average cost. And unfortunately, averages have high ends and low ends, right, Kirk? So you might say, well, the average is 6.99%, but what is the inflation on food during that period? It might be 13. Well, I don't know about you. I don't have to go to a restaurant. I don't have to buy a television, but I sure as heck have to eat. So your inflation may not even be 7%. It might be 13 to 15% over the same period. Now, all of a sudden, you're looking at all of those plans you had, preparing for all of those certainties or not preparing for those certainties of uncertainties. And you blink in 10 years from now, and if it's at 15%, do the math again. It could be 6 to 7 years from now. Everything you're paying for is twice as much as today. It's going to have to take a new focus. There is, as we've said it before, a paradigm shift going on. Got to plan for, I would say, you have to start planning for some more consistent and predictable ways of managing this. Because if you don't, a speculative approach or just going in blindly, it could blow up everything you're trying to do.
Yeah, no, I think that's important. I want to share a chart here based on kind of what Doug had said, which is we're going to show this chart. So this is the Dow, and for those of you listening, apologies, you can certainly go to the website and see this, but this shows the performance of the Dow from basically 1918 or 1915 up until 2022. Now, if you see here, you see in the 20s and 30s, obviously it was pretty ugly. It was a lot of big fluctuation, but end up being sideways for that whole period of time. Then, starting in right around 1966 until right around 1982, the market was also sideways. And then, if you look again, right in late '99 till about 2011, call it 2012, the market was sideways again. So there are these periods of time where the market goes sideways. There's some volatility, but it goes sideways. Now, here's what I want to show, because you can look this up yourself. Here's the inflation adjusted version, and this is really what's important. So now you saw the prior version. Here's the inflation adjusted version. What do you notice here? Well, this more or less the early 1900s is very similar. But look at this period, 66 to 82. Now, the earlier version was flat, right? It bounced around a little bit, but was more or less flat. The inflation adjusted, it dropped. It dropped from basically 8,800 down to a low of a little under 2,500. That is an enormous drop. Why? Because this is adjusted for inflation. So what this means is inflation far outpaced the performance of equities or just the Dow index during that time period. It lost, I don't know, off the top of my head, it lost about 66, 70% of value over that time. That's enormous. That's approximately a 15-year period. It lost 70% of its value in in dollar terms, right? In what you can actually spend it for in the store. That's enormous, right? And we're looking at it now and we're saying, oh, well, inflation will go away. What if it doesn't? How's that going to impact your purchasing power? We just went through a huge spike. You can see here, there's a huge spike from, the low of, I don't want to pick the low, but let's just pick, 10,000 up to, where was it recently? 32. So, that's a huge jump. And people made a lot of money, both in housing and stocks and pretty much any asset. People made lots of money and they have a lot of excess cash. Now what's going to happen when all of their assets are now devalued over time because there's a high inflation rate of whatever, 5-7%. Let's call it 7% based on historical numbers that Doug said. 7%. that's gonna deteriorate your value rather quickly. And if you're close to retirement, you're gonna feel this. So we bring this up just to kind of show the effects of inflation. And even though nominally, which is basically the number on your statement, it looks like things are going sideways, right? Let's take best case scenario because last year they went down, but let's say they go sideways for 10 years. So you made no improvement over 10 years in the value of your performance, but your portfolio is now worth a lot less over a 10-year period, right? It's worth 50% less or more. That's a bit of a problem for a lot of people if they're in retirement or getting ready to retire. And with all these people who have a lot of money, they have to find a way to hedge that inflation. Now, there are a handful of ways to do that. It's not easy. It's actually going to be a lot more challenging than in the past. So, all of those of you who are indexers are going to feel this pain. For all those of you who want the simple approach of just buy and hold or buy and hope or buy and forget, as I call it, you might also feel some pain. But I think those of you who are going to be more active and if you're listening to the show, you probably want to learn a little bit more. You need to find assets that are going to be a good hedge against inflation. And it's whether they're a good hedge or not is going to be highly dependent upon, if you kind of look at things from the perspective of what we normally expect, like real estate's a good inflation hedge. Yes, it is. For low, consistent inflation, real estate is a good hedge. Is it good in high inflation? Absolutely not. Is it good in hyperinflation? Absolutely not. There are certain things that are better than others. And historically, gold has been a good hedge against high inflation, hyperinflation, even moderate inflation. You could say, yeah, but it didn't do well last year. Well, first of all, 1 year is just 1 year. And two, it doesn't mean just because in the 70s it did well, it's going to do well now. That's actually not my thesis, because everyone who sells gold is going to tell you that. Well, look what it did in the 70s, and it was the best. There are other reasons for that. But I say that there are certain things that are good hedges against inflation. Gold is one because it is a good real asset that's a good hedge against inflation. Real estate's another one. The problem with real estate is it's also a business. So most people have it leveraged, which means let's say you have 50% of it leveraged. So you have a $100,000 property, you have 50,000 in equity. Well, what if that property goes down 50%? Now you have no equity. What if rents go down 50%? Well, now you've got a problem because you've got debt that is not declining, but you have an asset value that's declining, which means you're underwater. So leverage actually creates a lot of issues when it comes to inflation. Now, if you just own real estate outright and the cash flow is the cash flow, great. I mean, in Japan, this is what they did. Everyone allowed a slight devaluation every year. Nobody got fired. They just accepted lower pay. There was a collective cultural acceptance of deflation, and it worked for them. But we don't do that in this country. So you need to accept the way things are and just say, all right, how am I going to handle this excessive asset deflationary spiral that we might get ourselves into? And what am I going to do about that? So I'm just saying that you need to think about each of your assets. And I'm not saying real estate is good or bad. I'm not saying stocks or bonds are good or bad. What I'm saying is you need to be more agile. So if you're buying and hoping or buying and holding stocks, that's a bad idea. If you're nimble and you're agile and you're saying, hey, there's an opportunity here, let's look further into this. Great. That is a good thing to consider. Because what if stocks drop 50%? That's a good buying opportunity. What if they go up 50%? That's a great selling opportunity. I would not own stocks if you're up a lot from here. So you just need to understand in context where the assets are in the cycle, and are they a good point now, or are they going to be a good point later? I love equities. I love real estate. I love all assets, but each one has a time and a place. Do I want to buy 30-year treasuries at 1%? Absolutely not. Do I want to buy them at 10 or 15? Sign me up. I will buy as much as I can and twice on Sundays. It is just, you need to be at the right place. You need to buy at the right price at this point in the cycle. Because if you don't, you're going to get harmed. It's just you're going to lose value in your portfolio. It's much better just to be patient, wait for the right buying opportunities, wait for things that are reasonable value, and then acquire them. And you're going to do great during this period. But if you don't understand how to value assets, that's when you get yourself into trouble. Like, for example, if you're walking around saying, I want to buy real estate right now, you're going to lose money because now is not the time to buy real estate. There will be a time to buy real estate, but it's not today. And I think if you wait, if you're patient, you'll find opportunities that you will not expect, and there'll be great opportunities. But you can't walk around like a kid in a candy store during this time. You have to wait until it's maximum fear, maximum pessimism. That's the point in time you want to walk around with a bag of cash and just say, all right, I'm going to buy as much as I can. So just something to be mindful of. So, Doug, what are your thoughts on this? I know we want to get into housing too.
Well, yeah. So I was just kind of going back and kind of doing some real number crunching there on kind of what the S&P 500 has actually done over that 25 years. So I kind of want to get I kind of wanted to communicate on that from a planning standpoint, kind of some assumptions that people are using and making sure it's a fit. So in the last 25 years, so I was kind of looking at some different things. If you had 100%, all you did was throw your money in the S&P 500, right? Which nobody really does, and you can't invest entirely in index, so there's certainly some cost there. I mean, $100,000 over that 25 years could have become $1 million. So it's not bad. Okay, great over the last 25 years. All right. So, but here's the thing: there is there was incredible volatility that happened in the fourth year in. So again, from 97 to 2000. So you started to lose 9%, 11%, 22%, 3 years in a row. As a matter of fact, you weren't really starting to make money and really compound on this. It didn't even hit $400,000 until year 19, Kurt. Okay, so that's where really all we've seen is just a massively almost unprecedented level of compounding over the last couple of years. So that's, again, we talk about lost time in that. If you were to take and just look at a 6% rate of return during that period of time, and you would not have actually exceeded a 6% rate of return growth from the S&P 500 until year 16, year 17. Okay. So when we start to do those assumptions, if you've got advisors or you're looking at, well, hey, Dave Ramsey tells me I can get 12% average a year. It's just not been the case. Now you start adding into the fact that, well, how much time do you have to compound that? Even 10%, even an 8% rate of return was not achieved by the S&P 500 between 1997 and going back to, like I said, 16 years later, so 2013. That's how long it took you to basically get back to that. So if you're using 8%, it's just not going to be a good average for people to assume in a financial plan that takes into consideration all of the different variables. But I want to go one step further because, Kirk, do you know how many people do you know that hold nothing but the S&P 500?
Very few, if any.
Very few, if any. So let's just take a look at kind of what a typical portfolio might look like and say maybe if you're even growth related, you've got maybe 80%. They talk the 80-20 rule for a growth portfolio and use that result. Well, if we use that same result, now over the 20-year period or 25-year period, the ending return of that blended portfolio isn't $1 million. It's $500,000. It's 554, and it didn't exceed a 6% rate of return average compound until year 24, until last year, Kirk. So, or actually 2 years ago, because this is always, these numbers are 1 year past. So it wasn't until 2021 that a typical allocated portfolio for the average buy and hold person exceeded 6%. So if they're using 8% in their planning, which I hate to say, the industry thought was conservative. When you looked at, and I used to see firms that would publish 10, 12% assumptions in their financial plans they'd run for people. There's still people that follow Dave Ramsey and who says you can get 12% a year by investing in a growth fund. Well, a growth fund is not 100% invested in the markets. Okay, so it's still, in the S&P 500. So these assumptions are poor. I'm not going to call them untruth, but we like to talk about half-truths. You have to have stress testing. You have to look at the certainty of uncertainty. You have to really understand these numbers. And these are before inflation, Kirk. These are just the actual return. So when I do planning, we want to go back to simple assumptions. I use 6% as my general starting return which is half of what some people say you can get. And because over the course of 25, 30 years, it has historically beaten the market returns. But even from there, when I have a chance to work with clients and go deeper, we start to really stress test that what that's going to mean, because you're not the same as the next person. I'm not the same as you, Kirk. It does not come down to what we can achieve in the markets to be successful. And too many people think that. They use, the green line that Fidelity says, or all of these, firms that say, this is what you need to retire if you only have X amount. I don't know about you, Kirk, but I know I can name two people in the back of my head right now. One, if they had a $2 million saved up, the one person would run through that money in 3 years, and the other person would have 10 generations after them would still have money. No two people are the same. Assumptions and generalizations don't work. You have to stress test it based on your own lifestyle expenses, and you really have to know what's right for you. And that means working with someone.
Yeah, I agree. And I want to point out that one of the reasons that people use high assumptions, and Dave Ramsey's a little bit of an exception, he may be just kind of off the mark, but most advisors use high assumptions like 10 or 12% because they're trying to peg you thinking that they're going to get you 10 or 12%. It's all a mind game. It's all a facade that, and for those listeners who are clients or prospective clients of this firm, they know that we don't talk about things in that nature because it's not healthy. And it's how everyone's programmed to think. So almost every advisor out there, they'll show you this chart and they'll say, here's what I would have done if you were a client. And, oh, look at the great return I would have gotten you if you were a client. And, it's all this kind of psychological positioning. Well, if you were a client, here's what you've gotten. And it's all BS. There's no way. First of all, you wouldn't have gotten that because they just pulled up the prettiest chart they could find. And if their charts don't look good, they're going to pull up a prettier chart and say, look, you should have done this. It's not real. Right? It's what we call, it's not even a half truth. It's just outright lying. But that's what the industry does. So when they present it as, here are the numbers you should expect, 10 or 12%, it's just now, and I want to be very careful here. Not everybody's flat out lying. Some people are just not, I don't want to call them inept, but they just don't understand what they're presenting. They're trying to help people. They're trying to do a good thing, but they're presenting these numbers because the firm said, oh, well, you should use these numbers. And some of them just don't understand. So, I feel bad for them because the industry it's very manipulative. But I think as investors and potential clients of any advisor, you should really understand how the industry works. And these numbers aren't realistic. And even if the market is going up 10% a year, look back at history, it's not normal, which means that if it is going up 10% a year for 10 years, then first of all, it could be Bernie Madoff because that was the kind of returns he got. But assuming it's not Bernie Madoff, if you're looking at those returns, all it means is at some point it's going to revert to the mean, which means there's going to be many years of underperformance or even really bad years where it's not even underperformance, where it's, you lose money like last year, or I would assume probably in the next few years, we're probably going to lose money too. But if you kind of look at that, you need to understand the positioning that is being given. You can't take anybody's. So here's a funny thing. Our industry requires us anytime performance or numbers are given to say, past performance is not an indication of future results. Yet what does the industry do? They use past performance to peg your indication of future results. And it's just not true. So I don't even like using them because I think it's the wrong message to send. Everyone's expecting certain things and you can't know, right? If you started with an advisor January 1st of last year, the advisor is going to look like an idiot. And it's not their fault. Everything went down 10 to 30%, depending on what you were in. So unless you're in cash, you pretty much lost money last year. And so, there's a lot of randomness and probabilities that kind of come into this when things are being presented. So what we do is we look at things and say, here's your range. Here's what you should expect as a range. And here's the worst it can do. And the best, pegged to here's the reasonable best that you can expect. And within that range, you can at least give some probabilities, some expectations. Because I think the real harm with clients that they get is their expectations are skewed. And then, the advisor promises 10, 12% a year. And they're like, well, you didn't get me that, so I'm going to find an advisor who does. And of course, every Tom, Dick, or Harry is going to say, well, no, I can get you 13%. I can get you 14%. And then clients bounce around advisor to advisor, and they lose money because each advisor who's selling them that is telling them the wrong thing. And so they never really get settled, and they end up losing money. So the reason that individual investors underperform is because they're always looking for the hot dot. They're always looking for the shiny object rather than picking an investment philosophy or investor psychology and sticking with it, right? Warren Buffett is successful because he's doing what works for him. It may not work for me or Doug or you. Warren Buffett is Warren Buffett. And there's a lot of reasons he does well that have nothing to do with us. And, there are other people like Carl Icahn or David Einhorn, a few others that they're just successful in their own way. I couldn't replicate that. Seth Klarman, he's a successful value investor. I couldn't replicate what he does. So you need to find what works for you and to do that and continue to stick to it as long as it works, right? You have to make sure it works, but as long as it does, just stick to it. There'll be good and bad times, and you have to adjust your expectations to good and bad times, which is why when you have a bunch of good years like we had for the past 10 years, your expectations are going to be off the charts, and you'll keep expecting it because you've had it. It's just like anything else. Like you've had all these good years, and you have a bad year. Like, hold on a second, what happened? Well, it's normal. We just haven't seen it in a while. So I do want to. I know we've been kind of going down this rabbit hole. Go ahead, Doug.
I just want to add one quick thing, just tabs on this, and then we'll go to transfer. So the one problem that people run into, and this is the advisors and clients, 95% of people that focus on the industry, either within it or rely on it, they, in the absence of a solid plan, they rely on returns for their success. Okay. It's like, well, why am I not making enough money? Why am I losing too much when things are down? Why am I not making enough when times are good? And they all default to you need to make more money. You need to make more returns. First of all, there's a cap on that. You can only make so much because we don't control the markets. The markets are going to do what the markets do. Chasing returns doesn't work. The second side of that aspect is that unfortunately, in order to make more returns, for every every notch or percent of return you're trying to make, there's an exponential increase in risk. And unfortunately, that can completely deter your outcome. And so we believe very strongly, and there it is absolutely, so does Warren Buffett, by the way, because Benjamin Graham believed this as well, that it is absolutely more imperative to avoid losses than pick winners. The last kind of scenario I'm going to show you. So I talked about how, again, if an average person has 80% exposure to the market, even if it's in an index fund, there's no fees whatsoever. Over the 25 years, 100,000 would have been 500,000. Well, I want to compare something here. If you did the same scenario, okay, of market exposure to the S&P 500, Kirk, but you were able to minimize the downsize to a maximum of under 10% a year, the worst years, and actually have less exposure, so only 65% of exposure to the market, and pay a fee for that help, guess what? Your resulting outcome amount at the end of 25 years would be $20,000 better than being invested directly in an index fund with the S&P 500. You would have had $571,000 in 500 versus 555 in that index fund, which is why, guess what? It isn't all about returns, and it isn't all about fees. It's about having a plan, and actually having fees isn't the reason you're not going to make your financial success. Failure to plan is planning to fail. You got to start there.
Right. I'll appreciate that, Doug. So I want to bring up another chart here. So I put this chart up on LinkedIn this week, and it blew up. I wouldn't say it went viral, but it was really close to going viral. And here's the thing: most people, they can feel what's going on, but they can't put numbers to it. They can't put visualization to it. You feel like real estate's too expensive and you can't afford it, but you don't know why. This is a historical chart, and I could find one or two more charts that are similar. They'll show the same thing. But this is, for those of you who are listening, this is a historical chart going back to 1948, the annual mortgage cost as a percentage of household income. Now, when you go to buy a house, there's a ratio that they try to keep you under. If you go over that ratio, then you won't get the mortgage because you're spending too much on a house and too little on other things. So the lenders like to keep you within a certain ratio, right? Or else everybody would just go buy $100 million homes and they'd file for, they'd get foreclosed on 3 months later. But, within the ratio keeps you within reason of what you can expend on a house. Now, looking at this, what this shows is that normally, in a historical perspective, from where we were, 20 to 25% of your mortgage costs as a percentage of household income. So between 20 and 25% of your income will go towards your house. Now, if you look back in 1980, it peaked at around 52, 53% of household income went to what it cost to buy a mortgage, which means that people couldn't afford for a mortgage because they didn't have enough to live off of, right? Buying food, paying for gas, things like that. So that was the peak. And where we were in 2020, 21 was 20%. And for those of you listening, you know where we were up recently? 45%. So we're not at the highest it's ever been in the last 100 and whatever some odd years or 80 years. But we're the second highest. Instead of being 52, we're at 45. And you see the spike in the chart is enormous. This spike is 100%, or not 100, 99%. I want to be specific here. 99% of this is due to interest rates going from 2.5% up to 7.25%. And when you go that far, that fast, and real estate prices don't drop, it just means you can't afford the same home. So if a house was listed 2 years ago in 2021 for $1 million, and it's still listed for $1 million, it's not going to cost me 10 grand a month for that house. Now it's going to cost me 20 grand a month for that same house because my interest payments just went up. So what this means is, well, I can't afford 20 grand a month. That's like whatever, half my household income. So just looking at this, just understand that this shows affordability. So what we talk about on this show frequently, and every time I see a chart, I like to bring it up. I'm not a chartist, so we only bring up charts that other people bring, or else it'd be sitting around all day doing charting and not doing anything else. So even though we talk about it, I like presenting charts after the fact. And so those of you who are listening all the time, this, is that affordability is the big issue when it comes to housing. Is what people could afford before, a year ago, and what they can afford now are two very different things. People can afford a lot less. And yes, inflation's coming down, but interest rates are still going up. And we haven't kicked inflation yet until it gets to 2%, which I think will be a long time. We're not back to where we were. So I think people have to understand that this is a big problem. And I would not, and really what else this shows is you should not be a buyer of real estate. You should be a seller. I'm not saying go out and sell your real estate today. I would, but I'm not telling you to do that. I'm saying that it is a great time to sell. It's a terrible time to buy, because the difference, the equilibrium between what people are paying and where the price is are normally balanced, right? You could argue whether it's a good price or a bad price or whatever. That's irrelevant, right? Because people have wages, right? And then they have expenses. There's a certain level of affordability. Then there's what the house costs. Now, normally the house costs enough for what you can afford, and you generally know where that falls, and you accept a certain standard of living. However, if the house is worth double what you can afford, then you're not buying that house. Now you have to buy a house that's half the cost in terms of what's affordable. Well, I don't want to live in that house. That house has got problems. It doesn't address all my needs. I'm not living in that house. So then people don't sell or they don't move. So things have slowed down a lot. And I want to show another chart here really quick that is really important. And it shows new houses sold and homes under construction. So if you look at this chart, I'll try to increase it a little bit so you can see it. There's a blue line and a black line. The blue line is new houses sold, which has declined a lot. It's declined about 40%. And new houses under construction is still going as if nothing's wrong. It's just started to decline recently. But the point is everything in housing, and we're using housing a lot because it's so easy to digest, right? If I start talking about corporations and earnings, if you're not a business owner, you may not understand. So I'm trying to make this really digestible for everybody. So if you think about supply and demand, there's more supply of houses and we have the same amount of demand. Let's just say hypothetically. Well, that means the price is going to go down because you got more of something than you have of people willing to buy it. So now it's going to be worth less. And yet, if you look at new houses sold, the reason it's declining, this isn't house prices. This is the amount of houses sold. The reason it's declining is people are not dropping their price. So if you're building houses, you're not dropping your price, that's a recipe for houses not selling because you don't have buyers and sellers finding an equilibrium because the buyers can't afford this more expensive house. Oh, and there's more there, and they're building more of them. Okay, well, I'm still not going to pay that much. And so at some point, the house price is going to crash and it's going to go well below the equilibrium because that's how things work. But we're not there yet because housing market operates slowly, and this speed of the housing market move is really going to disrupt a lot of things. So you may not even see it till mid this year when people really start to drop prices. I know they've started, but I just wanted to point this out. So, Doug, what are your thoughts on this? I know you have a lot of thoughts on housing.
Yeah, so Kirk, I was trying to pull it up. We had some information that I saw the other day on Toll Brothers. Toll Brothers had, I think, the previous year they had something like 13% cancellation on new home purchases, and I believe that if the latest information talked about something like a 68% cancellation rate.
Yes.
I could be off on that by a little bit, but
No,
and
you're
that's just
correct. You're
yeah, that's
correct.
just absolutely astronomical. The number of people that have jumped in to try to start building a new home, and guess what? Toll Brothers, again, they've got their agreements on this, but a lot of this, these companies started to break ground. They already have. So the way the production homes typically work, so people like Toll Brothers and KBB and places like that, they actually buy up all the land ahead of time with the intent of then finding buyers that they are going to then buy into and help them effectively pay for the development of these communities, right? So they've got all these lands, they plotted it all out, and then their business is to sell you as to why you want to buy one of those spaces. Well, these cancellations are not going to create any less of an issue for a company like Toll Brothers or KBB. They've got the land there. They've got to start breaking ground on that because they've invested the resources to build this stuff. So some of the things that I keep hearing on real estate, and again, I've said this before and I'll say this again, and I don't think there is an industry out there, this is my opinion and I'll stand by it. I don't think there is an industry out there that is more insular and less connected to what's going on outside of the real estate. If you talk to anybody in real estate in 2007 and 2006, you talk to anybody over the years, they will tell you that prices never go down, that the real estate only goes up, that we don't have any impending issue coming. And they're always the last to know. Here's the reality of it. And I'm still seeing people out there saying, geez, the Fed's going to lower inflation. That's going to bring mortgages back down. We're going to be, this problem's going to solve itself in the 6 month. I don't see a housing crisis. Well, as you know, Kirk, and I know, but if I'm surprised that people inside the real estate industry don't know this, the Fed doesn't affect mortgages. They do affect HELOCs, right? That is directly tied to the federal funds rate because that is a temporary loan. But mortgages, although they are correlated to the Fed, they are based on different variables. And a lot of that has to do with liquidity backing from Fannie and Freddie, how many, what support the banks are going to get in terms of lending to people. And a lot of that has to do with regulation over the last, 15, 20 years since the last crisis. It has a lot to do with supply and demand, a lot of really not direct variables to what the Fed's trying to do. So yeah, even if the Fed does lower interest rates, which we have not been given any indication that's coming anytime soon, they are consistently saying they will not be happy until inflation hits 3%. We just spent a whole slew of this conversation talking about why that's probably not likely anytime soon. So even if it was tied to the Fed's fund rate, I don't think the Fed's going to lower interest rates down to drive mortgage interest rates down. But the fact that it's not is absolutely asinine that anyone thinks that a lower interest rate from the Fed is going to lead to this drop in mortgage prices. Could it? Sure. But there's nothing out there to indicate that we're going to see a turn here because the liquidity's gone. I've seen some economists lately have talked about M2 money. M2 money, I've talked about this before, was this flooding of money that came from COVID through PPP loans and everything else. It was unprecedented history how much money was basically just handed out to supposed to go to the American public, but what was it, Kirk? Something 30 to 60% of the money ended up in foreign hands, and we don't even know where it is. But let's just assume it got to the right people. That money
In
is sitting.
Ukraine, apparently.
Yeah, Ukraine, right? That's the part we might know about. But 30. So if we got trillions of dollars that, as of a year ago, they said was sitting in people's pockets being spent, and people still go, well, I don't know what we're talking about, a recession. Everybody's out there buying. Yes, they're buying with money and cash, but we just saw a report that there is I think up to 60% of auto loans are now going into default. I mean, again, some of these I'm going from memory, I might be a little bit off, but there's been a massive spike in auto loan defaults. Okay, the cracks are there. People don't have are running out of the cash to buy things. But when you have had 15 to 20 years of low interest rates, and an entire generation that came out of college or high school that has never experienced difficulty getting money, that's seen unprecedented levels of consumerism. I mean, the stuff that people pay for, the apps, the glitz, deliveries, Uber, cell phones, all of this stuff. Now money's drying up. And guess what? It's no surprise that people are looking at this going, well, I don't see what's happening. There's no recession. Everybody's still buying. Yeah, because they're addicted to it. And they have never been trained to go through any type of cycle in which money isn't there. And let me tell you, Kirk, the number one cause of financial stress is lack of access to capital. Okay. We haven't had to worry about access to capital for 25 years. You could get a loan for almost anything. I mean, prior to the Great Recession, liar loans, right? You could get a home loan with just by putting anything you wanted on an app. That got a little bit tougher, but still didn't take much to be able to get approved. Didn't take much to get approved for credit cards. Didn't take much to get approved for car loans. I remember when car loans were 1%, 2%. Anybody could get it. Well, again, the cheaper the money is to access, the more people will have that money, and therefore supply and demand. You have this huge supply of money, which creates increased demand against the supply that's out there and drives prices up. And that's what we saw in housing the last couple of years. Now all these people think that, hey, unlimited housing, we need housing. Sure, we need housing. But what do you think is going to happen? We already saw when Zillow dumped a bunch of homes, and I don't think they've all sold yet. What's going to happen if the KBBs of the world that have bought all this land now, have all of this space that they've got to start building? There's going to be homes built. They're going to pull back from that to try to suppress some of this supply, but we're not there yet. And so I really think people have to recognize what's going on here. It's all about supply of money, and we haven't seen that money dry up completely because of the money supply that was spiked 2 years ago. Over the next 18 months, we've now seen the numbers that money is drying up. People are moving on to credit. Credit's getting harder to get. Guess what happens? Lack of access to capital, financial stress. And there's going to be a lot of people that are going to see it for the first time in their lives.
Yeah, I think we're all in for a world of hurt right now if you're not prepared for it. And I think the big challenge here, we got to wrap it up here. We got a few minutes. But one of the biggest challenges is the psychological impact of what people are going through. And, if you're going through challenging times, one of the best things you can do is prepare mentally. It doesn't mean it's going to be any less challenging, right? I could say, well, people ask, well, what's the best asset in a high inflation times? Honestly, it's not about making money in high inflationary times. It's about not losing money. And how do you retain your purchasing power as best as possible? You're probably still going to lose. There aren't a lot of situations you could say this is definitely going to be the best thing. We don't know, right? I mean, you don't know what the future holds. We could hit hyperinflation. We could have massive deflation after this. Like, nobody really knows. We just have our theories based on history and based on what makes sense. But realistically, you don't know. So the best thing you could do is to prepare mentally for tough times. Make sure that you're spending less than you're earning, right? Try to be as thoughtful as possible about your investments. Find good values. Don't overpay. All these things that we talk about on the show really make a lot of sense to spend some time with. So, what we're trying to do here is just prepare you mentally for what is happening, what can happen. So I wanted to show this chart, and I want to wrap it up here. and I wanted to give you kind of an absurd thing to make you think. We start throwing these out here once in a while because there's so many of them in the news. But this chart here is the housing affordability. It just shows right here. I mean, this is the most it's declined. I don't know if it says in history, but I thought it was an interesting chart to show. Is it's a rapid decline in affordability. It went from like 100 and 180 down to 91, which is really unaffordable, and it's going to keep dropping. If you look in the early 80s, it went down to 60. So as long as that keeps declining, it's going to be less and less affordable for people to actually own a home. And all you really should do is just pay attention to the price you're paying and the value you're getting. So as we wrap it up here, I want to leave you with one thought and give Doug a chance to wrap it up on his end. But every week we come across these really amusing things, and I think I'd start with one of them, which is so there are 15,000 mutual funds out there. Half of them, at least in the U.S., half of them are run by portfolio managers who do not invest a single dollar of their own money into their own products. Now think about that for a minute. Do you want a mutual fund manager to run your money who doesn't have a single dollar into his own strategy? He's doing something different. He's saying, well, you should buy this, but I'm going to do this other thing over here. Half, at least half, have all of their money somewhere other than what they're managing. Now, this is kind of a complex topic. I bring it up because it's just something to think about. It's a question I always ask portfolio managers if we're considering them, is where's your money? I talked to one guy for mobile homes, and he was like, yeah, I invest all my money in mobile homes. I'm like, great. Tell me about your fund. He told me, and I was like, great. How much of your money is in this fund? He's like, zero. I'm like, why not? He's like, well, it's in all these other things. I'm like, so why don't you just put those in the fund and you can manage them all together? He's like, I wouldn't do that. I'm like, okay, so then look somewhere else for money because you're not getting any from me. Like if you have so little faith in your own fund that you want to put all your money into private stuff and put all the crap into the fund, I have no interest in you. And so I pointed out because sometimes there are reasons for this. So I don't want to disparage people who don't have money in their own funds. Some organizations actually don't allow it, right? And there are a handful of investment research firms that will say, we do not allow our people to put money into our own products we recommend because it's a conflict of interest. Okay, I buy that. If you have a standard that you sit with and you always stick to, I'll accept that as a standard, right? But the fact is most companies don't have a standard. These people have just chosen. A lot of them have chosen not to do it because they don't think it's the best thing for their own money. So I think that's a little absurd, but I just want to point that out because that's kind of how our industry operates. You have to understand the conflicts of interest. You have to understand the biases. And you have to understand that, what people are saying and what they're doing could be two different things. So in the interest of time, we're going to wrap it up here. So Doug, final thoughts. Where can people find more about you?
Well, thank you, Kirk. You can find out more about me through two different places. Actually, if you're a business owner, go to one of our businesses, which specializes working with business owners, helping you to kind of make sure that you build your business more effectively. If what you thought you knew about building your business turned out to be untrue, when would you want to know? You can actually get your complimentary one-page business growth guide. Simple, it's free from automaticbusinessmethod.com. automaticbusinessmethod.com. And if you are a family and it might be one and the same, you might be a business owner that also has kids that are going to be going to college, especially those that might have kid going to college here within the next 4 years. So if you have a high schooler, you need to understand the key data that's out there about college. You need to understand how to pick the right college academically, financially, and socially. College selection is the number one thing that you need to work on. If you pick the right college at the right cost, you have extraordinary opportunities. You can get free data there. We have key college funding data for 2022, 2023. You can get that free from our website at procollegeplanners.com. And you can also get information, our free cap report. So find out how much college is going to cost for you to up to 3 schools for free. Go there, download that. So automaticbusinessmethod.com and procollegeplanners.com for some free items that are very valuable to you.
Great. Well, Doug, once again, thanks for joining us. Thanks for sharing your wisdom with us. And that's the show for this week. Thank you again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast on the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Also, we're now on YouTube, so please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment in the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin, so please call him and express your feelings directly. If you're seeking financial advice, talk to an oracle, a fortune teller, or maybe a financial advisor. I'm one, but I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.